A lot of folks are really negative on banking as a service right now, even going so far as to say that it's dying. Is that really true? On the one hand, you do hear about certain platforms doing layoffs. You hear about a lot of consent orders going through the ecosystem. But on the other hand, you can find some providers who are doing incredibly well. If you look at Unit, for example, in 2023, their transaction volumes are up 5x to $22 billion. Their deposits are up 3x to $900 million. And if you take a step back and look at the ecosystem, so much of the innovation we've seen in fintech comes from the improvement in infrastructure, not least of which because of the work the BaaS providers have done. So for this podcast, I invited Itai, the CEO and founder of Unit, to come on and help us tease apart the signal from the noise as to what's going on in the ecosystem. The reality is the wholesale negativity is not warranted, but things are changing. And so we're going to cover what's going to stay the same, what will change, and also how Itai views his and Unit's role in the ecosystem. We'll also talk about why he hates the term banking as a service to begin with. Itai, why do you hate the term banking as a service or BaaS?
I think it was popular when we started the company back in 2019. And I think over the years, we've learned that it's inaccurate in two different ways. One, I think it describes the supply side more than demand side, right? So it's almost like calling an Uber drivers as a service. It's technically accurate, but it's not really what it stands for. It stands for higher mobility and more access to transportation. So one reason in which I think the term is inaccurate. The second reason, I think there are a lot of different practices and types of companies that came into existence since we started Unit and were there before. And I think there's so many different flavors of the modes of different operations and how to do business in this space that we think how it's now being used to describe too many things. So yeah, we tend to lean towards embedded finance right now, which we think is really descriptive of what's being built on top of platforms like Unit.
Yeah, and we start with these terms and we fill them with meaning, but ultimately they kind of grow and expand and shift, and then maybe there's an opportunity to redefine what that means. So, and maybe another interesting lens into that is like when you hear that someone say banking as a service is dying, presumably you don't agree with that because you're doing something in that general phrase, but you actually agree with some parts of that because maybe it represents an evolution. So what two parts would you kind of tease apart there?
Yeah, so I think it's important to look back at the history of financial technology in the US to really understand what's dying and what's only being born right now. When you look at the two different waves of innovation happened in financial services in the last 15 years, the first wave is companies like Venmo, and Lending Club, and Chime, and Robinhood, and many others who try to innovate on one product and basically increase access to for the consumer to consume this product in a better, faster, cheaper way. And we think that this wave has come to an end. So I think that's one thing that's done in fintech, that the old notion of a neobank or a company that's pure play financial services. I think it's hard to start these companies right now because the market is saturated. I think investors like you take note and founders take note, and less people are trying to start these kinds of companies.
In 2014, as I talk about a lot, there's that famous picture of the Wells Fargo homepage with all these fintech companies unbundling being better point solutions. So I think that's kind of what you're getting to with 1.0.
One of the themes we'll discuss today, hopefully, is really our take. I think we share a take that the future of financial services is now rebundling, and it's here to stay. And we have good reasons to believe in that, and we can kind of dive into why.
Yeah, I totally agree, and I want to bookmark that and go deeper. But I think one of those things people struggle with the term banking as a service or embedded fintech is just understanding what it is. And so I'd love to talk through, 1, 2, or 3 of your customers and understand how they're using your platform. And from that, we can use it to build and understand why you want to change what the definition of banking as a service should mean.
So some of our customers that I think represent an increasing level of interest in the space. One company is called Nav. Nav is a pretty successful service for businesses that has been around for a long time. They are almost the Credit Karma for small businesses. They have millions of businesses using them on the platform, originally to get a sense of their credit worthiness and their credit journey. But over time, they've introduced more financial services to their product. And today, they're giving multiple native financial products inside the Nav product. So one, you can see that they give a business checking account alongside other options that they help you evaluate in the ecosystem. And the second is that they now are in the business of offering you credit cards for credit building purposes and for access to credit. So that's one type of embedded finance product that's being built. Nav is a company that creates a relatively standard business banking experience. So it's not a a completely different take on financial services, which we'll get to in a second, but it uses their distribution to increase access to high quality banking and credit building.
And to your point, they're kind of a horizontal platform
Correct.
that has multiple products bundled together under one roof, which 10 years ago you probably wouldn't have seen. And did they start with a single product and then start to roll out more with you? Like, what's the story of how they started to work with Unit and move into that multi-product footprint?
So the journey has been business checking first. So first it was important for them to allow businesses to continue taking loans from multiple sources, but have them flow into one NAV-hosted checking account. So that's the first product they've launched, this third option here in the menu. And then over time, they realized that an additional premium product they can offer those businesses is a credit building credit card or charge card. And this is what they've built with a second option here. So they've really layered these products on top of one another. The business model for them is actually very interesting. The credit card is only offered to a prime population or a sub-segment of their end users, because not everyone should get access to credit, or at least it is deemed credit worthy by the underwriting engine. So they select the businesses that might be eligible for that, and they allow them to basically consume a subscription model that includes a credit building charge card. So that's a layering of financial services, but with checking account, which is very broadly accessible at the core.
Yeah, so starting with one product, layering on others over time, and then also having a different bundle of products depending on the exact profile of the business.
Correct.
And can you share a little bit about like what kind of scale they've operated at, and maybe if they have any kind of things they're thinking about building out in the future?
Yeah, so can't go into specific plans of specific companies. This is something that I want to allow them to share. But they're definitely doubling down on the fintech strategy, and they have a pretty heavy distribution of, they have hundreds of thousands of businesses on the platform as a company, and they introduce financial services to a lot of these relationships. They're actually one of the fastest growing customers on Unit as well, so it gives you a sense of their growing distribution.
And I think I can share, because you can go on their website and find this. They say on their website, they have 500,000 businesses total, and then you can imagine the attach rate to some of these other products being, some meaningful percentage of those 500,000 total. Great example of like a horizontal platform growing into more areas too. I think maybe a good second customer to talk about would be someone who'd be more of a vertical play and what that can look like. So we can understand like banking as a service or embedded finance has actually multiple ways in which you can approach building a business.
Yes, so actually I have two different examples. One of them is a bit more individual focused, and the next one is going to be a bit more on the professional and vertical side. This one is a light but fun use case. It's a company called Variable that serves hundreds of thousands of workers in signing up for logistics and manufacturing jobs in their cities. So they're a labor marketplace for employers that want to be able to access these employees, and for the employees themselves who are looking for jobs and want to sign up for them or for shifts, get trained, get compliant with different labor laws, and then complete their shifts. Variable likes the idea of paying at the end of shifts because it helps them retain employees on their ecosystem. So they came to us about 2 years ago. They described that they want to achieve basically a faster payout engine for the different people that sign up for their product. If you're a Variable worker right now, you get a built-in wallet into your Variable app. So the same app that you've used to sign up for shifts is an app that now has a balance. This balance has a card or more than one card, and this very balance is the balance into which you get paid at the end of the shift. So in the past, you used to wait 4 to 6 days, depending on the employer's payout schedule, to get paid and feed your family and pay your rent. But with Variable, there is basically a book payment, a batch payment that happens at the end of every day that credits your wallet or credits the wallets of tens of thousands of people and allows them to get paid for the shifts they've just completed.
Yeah. And so they're kind of a labor marketplace. And maybe 5 or 10 years ago, if you're a labor marketplace, that's great. You can get paid placement fees. You can help with discoverability, but you probably can't embed a wallet and accelerate payouts. But today you can. And then that changes potentially what a marketplace could look like, what product a marketplace could offer, how a marketplace could potentially monetize. So I know that's maybe even, I don't know if I'd even think of that as vertical. I mean, these are all nebulous terms, like a vertical solution so much as like a marketplace oriented solution, which is still very cool. I think you have another one that's more of a kind of a vertical banking solution too, to talk to.
Yeah, that's one of my favorite, maybe more advanced use cases that have been built on top of Unit. So Baseline is a company that helps tens of thousands of landlords get access to banking for their properties. So the type of population they serve is usually people that have 2 or 3 units in their city or somewhere in the US. And those people tend not to have access to really high quality management services because they're individuals. So Baseline is their one-stop shop for everything they need for their properties, from insurance to accounting to bank accounts. And part of the experience is that when you sign up for Baseline, they're helping you set up multiple bank accounts that correspond to your multiple properties. They also help you set up different bank accounts for the purpose of deposit taking, deposit releasing. And then what I like about Baseline is that they give money meaning, right? If you go to JP Morgan or Wells Fargo as a landlord, the bank account doesn't really speak the language of rent. They don't speak the language of bill pay and expenses and equipment financing, or deposit taking, deposit releasing. They don't connect your rent signing with the actual act of deposit taking. So Baseline is really
there's
a
no
workflow
escrow
tool.
account for security deposits. Yeah,
Exactly.
as a landlord, I can tell you, the bank account is just kind of this weird thing that doesn't help that much with anything.
It's a dumb database of money, right? Like it's helpful. It's something that we've gotten used to consuming as people. But I think these products really try to marry your language as a landlord and your workflows as a landlord and the automation that you depend on with the money side. And I think giving money meaning is really one thing that we keep going back to at Unit.
Yeah.
All these vertical use cases are trying to annotate these money movements, money in, money out, with something that you might care about.
Yeah. And I think, so we're talking about with all of these, there's product innovation because you're bundling a bunch of products, right? Whether it's horizontal, whether it's like a marketplace, or whether it's a vertical thing like Baseline. Mm-hmm. But there's also some business model innovation. Like if you look at that Baseline website, for example, it's like get 4.19% interest on your checking account. Well, my bank account as a landlord at Bank of America, they don't offer yield because that's how they monetize. But when you look at someone like Baseline, they have a different business model too, right?
Correct. They get paid subscription, and they sometimes connect the subscription fee to how many properties you have. So they can play really interesting games with loyalty. Loyalty and say, if you have more than 3 properties, you get you pay more on the subscription side, but you might get access to better financial terms. If you have less than 3 properties, maybe you don't get paid interest as an example, but you also don't pay high subscription fees.
Yeah.
So they can basically manage the trade-offs between the software side of things, the financial services side of things, and they can also treat different populations with slightly different schemes that might be relevant for them.
Yeah. If you're bundling multiple products, you can commoditize your complement, which might be a high yield checking account, but still have a good business model, right? Correct. If you're Bank of America, you can't really, like you have nothing, you have no complement to commoditize.
You can't exactly. Yeah. I think there's an interesting question of whether banks are going to take more interest in software services over many reasons to believe that it won't exist. But if banks don't manage to become friends of companies like Baseline, I think you and I share the view that in the next 10 years, they're going to lose deposits and lose business all the time.
Totally. And let's go there. And I think that's a very interesting thing to talk about is like, what does it look like for the ecosystem at large when you have these multi-product companies that have differentiated business models, differentiated value propositions, and then also to some extent differentiated distribution because of how they monetize and have differentiated products?
I think what companies like Baseline represent is the move from the old fintech, of fintech 1.0, where your only hope as a new entrant was doing what the old and established companies are doing, but try to gain market share. I think your point is, Rex, that in the new era of fintech 2.0, companies are embedding financial services in successful software products that have an existing business model, and that I think this time they stand to win. I think your comment about trust distribution, using the data, using diverse business models is what we saw at the beginning. We basically saw that this wave was going to be different from the first wave in 2 main ways. And then the tooling is a separate question. One way in which it's different is I believe there are 10 times more companies like Shopify, Toast, Gusto, and Baseline in the world than the Chimes and the Venmos. So the bad news for the banks is that the number of challengers that are coming after them in the next 10 years is 10 times bigger because every software company can think of creative ways to bake money into its experience. So that's one main difference. The second...
And a lot of people call those companies vertical SaaS companies, right? And vertical SaaS companies were used to be a little bit of a pejorative term because how much you could earn per customer wasn't that much. Like maybe it's $1,000, but if all of a sudden it's $1,000 plus payment processing, plus lending, plus payroll, it's like, oh, maybe it's $10,000. All of a sudden you can invest in the go-to-market, you can invest in the product and the product experience, and it's a very different. So another way of saying FinTech 2.0 is a big part of that is vertical SaaS.
Correct. And I think it's not only FinTech. If you think about what makes money for these vertical SaaS companies, Baseline actually makes a lot of money from insurance. So I think you and I can talk today about this notion of embedded everything, not just embedded finance, but embedded accounting, there's banking, there's lending, there's insurance, there is payroll, and all of these things are money related, but there are many more forms of embeddable functionality that can help the Baselines of the world expand their lifetime value per landlord. And I think a lot of them are going to do it, including companies like Toast that you see here on this list.
Yeah.
So going back to the advantages they have, we think about the next wave as both bigger and more formidable than the first one. The winner, in my opinion, is going to be the challengers this time. These companies build software, they build trust, they build distribution to their customers, and they have a lot of data. You can think about a company like Toast as the best example for that. They serve 90,000 restaurants nationwide, and they just keep growing, and they get deeper and deeper in business with these companies.
Yeah. And if you think about banks, they kind of bundle a bunch of generic problems or generic products that are like good enough for most people, but not tailored to anyone. Whereas the vertical SaaS or the FinTech 2.0, it's the opposite. They bundle not just financial products, but a holistic of potentially workflow and insurance and banking and payments that are tailor-made for you. And so banks are bundles of products, which afford them certain like interesting, ways of investing in their go-to-market, investing in their brand. But now the rules of the game are being changed a little bit. And we're very early on, so we're going to have to see exactly how this plays out, but it's going to be very interesting.
And I think you can see how these different elements of data and software and trust and distribution feed into each other and create a flywheel for these companies. So, there's no world in which it makes sense for a landlord in 5 or 10 years to go to JP Morgan if they're using Baseline, right? If they're signing up for Baseline after they've acquired their second property. They're looking for better rent collection, deposit taking, deposit releasing, bill pay. What in the world would make someone walk into a bank? Maybe financing relationships, maybe these things are going to continue to exist. But I think that the attraction of these companies is going to be very, very strong. And I think it's a little bit like, thinking about credit cards 15 or 20 years ago. Not everyone was comfortable using a credit card online 20 years ago. My dad wasn't. But today it's so basic that you would be paying online with a credit card. And I think the same is going to be true for how intuitively we think about money in these software products.
Yep, totally. And it's kind of a one-way street. Like maybe we build, hundreds of vertical SaaS companies. Maybe a lot of them don't work. But if Baseline really starts or continues to keep working, you're right. Once you move into that, why would you go back to a generic bank account that doesn't do these 10 other jobs? Like it's very, very hard. These products are much stickier once you're in them than existing generic bank product.
Correct. And there's an additional, I think, opportunity for companies to layer more services. Let's think about accounting as something that's almost inseparable from banking, right? Every accountant that serves you as a landlord needs access to your bank account. If Baseline is now hosting your money and it's giving you an opportunity to move money and see money, and now there's an accounting solution that's built on top of that has visibility into the money and maybe control over the money, you can imagine how it's very hard to go back to a JP Morgan because the same accounting solution that depends on high quality access to banking data cannot get this from JP Morgan, but they can get it from a natively hosted bank account that lives inside of Baseline.
And I think something that's non-obvious about some of these players is that when you have a multi-product solution, yes, that's very hard along many dimensions, but some problems actually get easier. To your point about accounting, if you are the bank account, you are the general ledger, and you map everything into your own data schema, accounting goes from being a very hard problem, or not a hard problem, but at least a hard to automate problem, to an easier problem that's easier to automate than if you're a tech-enabled generic accounting solution, right?
Correct. The same goes for companies like Toast that have the knowledge of who are the employees in the restaurant. They know who signed up for a shift. They know who started and completed a shift. They might even know how much you had in tips. So they know who is a better service giver than other people, and they can really reward people for these types of activities. So I think maybe something that happened in HR systems with Rippling is going to start in a lot of vertical types of software, which is because the company sees more of this broad picture about the business, it's going to be in a better position to connect the dots and layer on more services, including financial services.
Yeah, and as a technologist, I'm really excited to see where that goes, because you're right, like there are interesting things you could do that you could never do before, and you can do them because one, you actually have the data and the connectivity, and two, you have a business model that allows you to invest in doing those things on top of your existing platform. And so we're starting to see what some of those things look like.
Said differently, I think it's less capital to get into a new line of business than it was 5 or 10 years ago, right? You can see yourself as, if you're a vertical SaaS app, you can see yourself almost as a thin layer that makes functionality available through other infrastructure providers.
Yeah.
You can give payroll with company A and banking with company B and insurance with company C. You don't actually have to build payroll systems and banking systems and insurance systems, but you need to get in business with these infrastructure companies that then bubble up this functionality into your UI, and that's, again, not as expensive as it used to be. Companies like Shopify had to invest millions in standing up basic and banking functionality.
Yeah.
But this is because the units of the world did not exist 5 years ago.
And I'll talk my own book, which is also a little bit your own book. I have a company called Every. They do embedded banking,
Great company.
Payroll, accounting, finance, tax. 3 years ago or 4 years ago, if someone told me that, I'd be like, haha, no, right?
Yes.
But today it's conceivable. And that's really, really exciting. Another shameless plug, if you need a full stack solution in your new company, you should check them out. But anyways, just the idea that you can build these things is so cool. And that's really, really exciting. So I feel like everything we're talking about is kind of negative on the banking ecosystem. Generally, it's like, oh my God, your customers are going to get stolen and you're going to lose all your... But you also partner with banks. So talk to me about where banks come into this equation and what those partnerships look like. And how banks should think about this state of the world, understanding, it probably is going to happen, but we're in the very early innings.
Yes. So putting aside some, I would say current events in the regulatory system, which make it challenging for banks to operate. Let's just take a step back and think 5 or 10 years ago. For a company like Chime to exist, for a company like Venmo to exist, or for a company like Lending Club to exist, back when they were just a lender, they depended on bank relationships. In the US, the regulatory framework forces any company that wants to deliver financial services to partner with a bank. There is no other way to do it from a licensing standpoint. So banks are becoming critical nodes in the system, in the sense that every checking account that you might sign up for through Chime is actually delivered by an underlying bank partner. Every card you get as a Chime member has a name of a bank on it. This bank is not Chime. This bank is Chime's bank partner. So the only way for companies like Chime and Venmo and Lending Club to exist over the years was to partner with a partner bank. And this is still true. The only way to operate in this ecosystem is to partner with a partner bank. So partner banks are very critical in terms of their place in the ecosystem.
And I think you and I are both aligned that that's going to be the case for a very long time. Like maybe around the edges, there's some changes. Like recently there was a proposal that maybe you have a federal money transmitter license. So you don't need like 50 state licenses.
Yes, but this is a marginal improvement and it's still in the bank.
Yeah, that's just like a marginal thing. Yeah.
The money needs somewhere. The banks are connected to the payment systems, including Visa and the Fed and MasterCard. And this is the only way to store money, move money, and lend money in this ecosystem.
Yeah.
There are a couple of exceptions, but we won't talk about them today. Largely speaking, this is still true. So any company...
There's some, years ago, there's some maybe there's a fintech charter, and that took 3 years and didn't really go anywhere. So yeah, I think generally aligned banks, they're definitely here to stay.
Yes, for sure. So now the question is, what is the cost of doing business with a Shopify for the bank? And what is the cost of doing business for Shopify in this type of relationship? So historically, when companies like Toast were being built in the early days and launched their banking products, they had to find these bank relationships, sign them, and then build a lot of and a lot of layers of to the bank that they were delivering the financial services in the right way. So Chime had, Venmo had to do it, Toast had to do it, Lending Club had to do it, and this is all a collection of practices that basically say the bank allows me to distribute banking or lending on their behalf. I have a whole bunch of responsibilities as a result, and I have to prove to the bank that I'm worthy of distribution because they are the regulated entity. When they get examined, the examiner wants to know that I, as Toast or Shopify, am distributing these financial services according to the rules and regulations. So that's the framework. We are trying to help in the sense that we've built an operating system that has a lot of bank-facing features and a lot of enforcement and real-time visibility into how each partner operates. So we haven't changed the model in the sense that we are trying to do things any differently. We're just trying to create more consistency in this ecosystem. As an example, we only generate statements in one way for banking and in another way for lending. And those statements need to be accurate because both the clients, the everys of the world, don't have to generate statements themselves. They can depend on us. And the banks don't have to be suspicious towards the everys because they can also depend on us. So if you take a lot of these elements that basically repeat themselves in bank fintech relationships and you try to make them consistent, make them follow one recipe, make the bank have real-time visibility into how the client operates, make the client have real-time visibility into what the bank is requesting or changing, we can make those relationships smoother and safer for both sides. And I think that's the unlock. Behind the scenes, our technology is being used by a dozen partner banks, and those partner banks are the banks that companies operate with when they work with Unit. They don't actually work with us as a banking institution, they work with the bank itself in a direct relationship.
You know, there are fintechs, there are banks. They could do partnerships directly. Why do you need someone like a Unit to help facilitate that kind of connectivity?
I think it's important to have some maybe regulatory empathy in this type of situation. Why should one be even concerned about risk surface areas that open up when there's a company that helps deliver financial services on behalf of the bank? So let's rewind 10 years ago before Unit existed and ask if there's a Toast or Shopify or a Chime, why is it even more risky than us walking into a JP Morgan in our city? And the answer is there's a lot of surface area that opens up once financial services go digital. The risks that open up are, you insert one more link in that chain. There's no longer a JP Morgan and a restaurant. There's a bank, Toast, and a restaurant. The existence of this one company between the bank and the restaurant creates not picking on Toast, this is just a structural observation. There are marketing questions that open up. Banks know how to market. Can you ensure that companies are compliant with marketing guidelines, even if they're not the bank themselves? They might not be as educated or trained in this. That's one surface area that opens up. Another surface area is fraud. Can these companies achieve normal fraud results or normal fraud situations? Because the old banking system, the one that required you to walk into a branch in your neighborhood, was definitely better suited to verify identity.
And they maybe aren't even better at identifying or at doing identity verification. It's simply more costly as a fraudster to run experiments on how to circumvent it if you have to send people into a branch.
Exactly. So there are many structural questions that open up, but I understand why other things become risky. Another example is complaints, right? If people have complaints about financial services, banks know how to take them and respond to them in a compliant way. Tech companies are not always trained in the same way. Money laundering is another thing that opens up. If you're a bank that can verify one's ID or passport, you're not as exposed to potential bad players as the online company is that usually acts in a very, very different scale. So I think there is a very, very big room for concerns in general when you talk about the transition from traditional financial services to digital financial services. So that's even before Unit exists. When we started the company, we looked at what all these companies like Chime had to stand up to convince the bank that they're compliant with regulations. They had to build statements, they had to build identity solutions, they had to track fraud and report fraud back to the bank. They had to charge fees in a compliant way. They had to collect disputes and complaints in a compliant way and report them back to the bank and follow all the guidelines that come with them. They had to prevent money laundering. There's a whole bunch of things that companies need to get right. And you can continue to do things in these ways. I just think that for software companies, they expect to be put on an ecosystem or an operating system that is a bit more opinionated in a way. So there's no reason for a company in vertical SaaS to learn how to generate compliance statements. There's a task that you can take and make uniform between the bank and the tech company. You can bake it into software that enforces the compliant creation of statements. You can fire a webhook at the beginning of the month and tell the company statements are now ready in Spanish and English. You can distribute them to the end users, HTML and PDF. So you can do that. And you can avoid this suspicion between the bank and the tech company because there is an engine that enforces all of that. So I think the way we like thinking about this ecosystem is enforcing and giving visibility to banks into what's happening with these different software companies that have direct relationships with them is a hard task. It's an undifferentiated task, and it's a risky task as well. So what if you have an operating system that reinforces and automates all of the rules and all of the things that no one can deviate from? As an example, in the old days before Unit existed, you could technically create an account and a card for someone without verifying their identity. It's entirely possible, 10 years ago in fintech, for a company like Chime, technically possible, of course, they have reasons not to do it, but it's entirely possible to create a card for someone without fully identifying them. But with our technology, the bank knows that there is a software layer that enforces a proper identity check and a proper screening of applicants. And if I have your details, but you've not been approved as an applicant, there is no technical possibility of creating a card or a payment or storing money on your behalf. So this enforcement, we believe, helps. Of course, one can continue to build the same software.
And maybe to draw an analogy to technology generally, if anyone's familiar with Ruby on Rails, it's a framework that's known for making it very easy to build things quickly. And one of the core tenets of Rails is convention over configuration, right? At first, when everyone's building web apps, everyone has their own conventions. It's very messy. It's very hard for you as a developer to come in and be like, what am I doing? How does this work? How does this app work? And then Ruby on Rails came along and they said, look, we're going to make it very easy. We're going to be a very opinionated developer tool that believes in convention over configuration. And so any developer can show up in almost any Rails app and they're like, I understand how this works because it's highly opinionated software. And for the most part, that Rails has been the most popular framework for folks in the 2010s. Then you get to a point where maybe some people are like, look, I don't want the convention, I want the configuration, and you change things. But convention, to your point, can have a very important role in de-risking things for the fintech who's developing the product, the bank who's partnering on that product, and the regulator who's looking into it if it's kind of a conventional configuration. So would you agree that that's kind of the articulation of like convention over configuration?
Yes. I would say take 10 different fintech relationships that existed 10 years ago. There are definitely ones that are being done right. Real-time data access for the bank, high quality reporting for the bank, enforcement of all the things the bank cares about. But the banks had to oversee them one by one, all these different 10 programs.
It was hard because they were pioneering, like people were hacking together programs on top of prepaid debit cards to do the first BaaS partnership. And like no one had done it before.
Exactly.
So like you couldn't have convention because no one had figured out any configurations that worked at all.
So if you want maybe a mathematical way to think about it, banks in many cases had 50 programs before it existed. These 50 programs had 13 different surface areas each. Money laundering or statement generation or fee assessment or disputes and complaints and reconciliation and many others. And banks just had to multiply 50 programs by 13 surface areas equals 650 surface areas that I have to monitor as a bank. I have to ask 50 different companies for their Excel spreadsheet of disputes instead of having one central operating system that allows me to just see everything in real time and doesn't even allow companies to manipulate data. So it's a very powerful assessment that banks can now have over their fintech partnerships require taking a step back and asking how can you make everything consistent and uniform. And to your point, Rex, I think if you're building something extremely fancy, a firm has some really sophisticated debit on top of credit or credit on top of debit products and sophisticated ledgering, this is probably not the kind of stuff that you can build with Unit in 5 days of engineering. This is the kind of stuff that might require in-house ledgering and in-house compliance and assessments of different risk surface areas, but we're perfectly fine not taking this type of business, right? We
Yep.
want to support the more conventional use cases.
Yep. And to your point, Unit's goal is not to be everything to everyone. And in fact, other models can and will work as the ecosystem expands, which is great. And so it might be large companies like Affirm who are like, clearly, I don't want the conventional opinionated approach because I need something more custom. And so they don't talk to you. Or it could be some of your own customers for some of their own products over time decide,
Correct.
I'm going to take this piece of it and do some of my
Correct.
own stuff too.
Exactly.
Yeah, and I think that's why it's such an interesting time is like we have enough scale where you can actually have some conventional configurations that have broad utility in the space. And we also have players at scale who can do these kind of opinionated, sophisticated things that are more customizable. But then we have this other layer of like regulatory like adjustment. And I totally do have sympathy. It's like not an easy job to think about all these players and what that looks like. As you think about, I think it's been an interesting jumping off point to talk about your product and your product roadmap, right? Because we just talked about convention and configuration. Well, if you're building a new product or a new program, how do you think about what the configuration should be, given you don't have as much, evidence of other programs to design that? And then it would be great to talk about some specific examples of the kinds of things you expect to be building and launching in the next 6 to 12 months, or that you announced in the last, 12 months.
So 2 different ways to think about our offering, and then we can dive into some flow of funds that maybe breaks down a specific use case. So think about our offering and what the banks behind Unit offer, or the banks that use Unit offer rather, in 2 pillars. One is embedded banking. So for any company that wants to launch accounts and wallets, issue cards on top of them, and move money in different ways, the infrastructure allows for that. So storage and movement of money, that's a very essential piece of what we do.
Yep.
Lending is a relatively new offering. We don't provide any lending for consumers. Our bank partners are supporting programs that provide charge cards for businesses or other forms of credit for businesses, and that's the offering as of now. But you can think of it as credit cards or charge cards, cash advances, and receivable financing. So we have these two different pillars, banking and lending.
So new product, B2B, embedded lending, but not consumer.
Correct. And in terms of the evolution of the product, so I can speak to maybe a few different dimensions, one of which is a bit more static, one of which is a bit more dynamic. What's static in financial services, in my opinion, is that I'm not going to stand here in 5 years and tell you that we have more than these two, because banking and lending are the 2 sides of the banking ecosystem, and I expect these pillars to stay pretty constant. I also don't expect to have entirely new forms of payments, because in the US you have established forms of payments, including ACH, same-day ACH, wires, checks, and Unit supports all of them. Unit supports cards. So we've established our kind of full access to the payment rails. So that's also not going to be a form of innovation, right? There's a finite way to innovate as far as the storage and movement of money. I think the main ways in which we can innovate are software ways, right? So it's easy to store money, it's easy to move money, but how can you create more compelling experiences for the companies that build with Unit and for our partner banks in scaling these activities and making them successful? So one way that we are definitely innovating is we're trying to take the product as close as possible to one line of code to embed Unit in any software product. So you can envision, now years ago when they made the decision to work with Unit, they might have had an option to go with a one line of code option that basically embeds banking in their user interface and has it on their brand, but maybe doesn't force them code. How to balance, how do you expose statements, how do you show the disclaimers when people sign up, how do you allow people to fund their cards, create cards, change PIN. This is all very commoditized, and companies find themselves building this over and over again. But we want to get to which there's a one line of code that basically populates the entire financial experience under your brand. So that's one flavor of innovation. We have a middle way between full code, which is API based, and one line of code. We also have a component approach, so maybe not this entire screen, but the different components that show card details or statements or balances. Maybe these components are the ones that you want to drag and drop and put in your app. So that's that's definitely one form of innovation and roadmap push at Unit.
Yeah. And so one example of that basically for a long time being API driven and convention over configuration, but still a lot of work to build on top of the API. Whereas now you're like, look, we figured out convention to some extent for the right kinds of customers. We'll also bundle in, the UI as well.
Correct.
On top of our API platform.
Correct. And again, thinking about the nature of the buyers in the next 5 years, these are not going to be companies like Chime and Lending Club. These are going to be companies that have a software product. They don't necessarily know much about fintech. They don't necessarily know what's the difference between ACH and wire, but they want to have a component that allows these businesses to make payments. So we've built that component, and we show fees in a transparent way. And we show the settlement times in a transparent way, and we don't force them to learn how to do it.
And this is probably not their core product. It's one of 4 or 5 things, and the 4 or 5 other things are the main value drivers. And this is something that helps entrench, enhance monetization, and create better experiences. So I think that's great just in terms of understanding one of the big changes in terms of making this like really, really easy. But I think it'd be fun to talk through some of this newer, simple features. I think we've got things, we talked about the white label banking app, but sending checks, transaction enrichment, cash deposits, expanded lending we touched on. I'm curious if there are others kind of particular smaller things you guys are working on.
Yeah, so these are a lot of experience enhancers, I would say. One of the things that became possible when we launched native integrations with the payment networks is that things like check writing become possible. So we now have a new API method that allows you to specify which account you want to send the check from, what's the destination, the amount, and then we print and send the check to a recipient. And once they deposit that check, the account basically is being debited and the funds go to the other. So we're trying to make these experiences very comprehensive. Again, I would say that at the edges of the experience, now we're trying to innovate. Transaction enrichment is one of my favorite things. I think in 5 years, every consumer and business are going to want to see the logos of the merchants they're spending on and maybe some more details. So we're trying to really push the user experience that I think makes people maybe have a more friendly relationship with their money. We also launched recently cash deposits to the Green Dot network. So Green Dot has a huge chain of locations in different Walmart and Target stores and convenience stores nationwide. And if you have a unit-powered bank account as a consumer or a business, you can now show a barcode to the cashier in these locations. You can give them cash, and then they scan the barcode, and the money pops up in your account based on this arrangement. So we're launching all these new ways to move money into the ecosystem and use funds. I would say, again, if you think about the mainstream ways to use money in this ecosystem, they're pretty finite. I think what gets me, there are 2 invisible things that get me more as far as roadmap. One is the bank-facing side of things. So banks are going through exams, and their exams are getting educated on these new ways of distributing financial products. The examiners have requests. After SVB happened, examiners were wondering about the deposit stability at banks. And we have reports that help them demonstrate this type of stuff. So the reports we're building, the engagement we have with our partner banks, make them more exam ready. We are not the regulator, they are, but we want to help respond by building more for them. And we have a full team at Unit that only focuses on oversight for the bank partners. That's the biggest team at Unit, and that's one kind of theme of features. Another theme is think about the client-facing stuff. So if I'm Baseline and I want to offer a full interest rate layer or tier for one group of landlords and maybe 50-50 interest share for another standard group of landlords, it used to be very heavy and expensive to do it. Companies like Baseline had to code the rules and calculate interest, but Unit has turned this into a policy decision. We allow them to have buckets of different end users, and we allow them to shift users between these buckets with the right disclosures. The bank likes that we are enforcing these interest calculations, and we are programmatically, by policy, creating them, rather than letting the baselines of the work hard. That's another example for something we can do that makes it easier to succeed, but again, doesn't reinvent any payment methods. This is not what we are here to do.
So there's stuff that helps your bank partners and regulatory comfort. There's stuff that after you're live enhances the value you can get out of the platform. And I think you're also doing, this is probably the other bucket of like increasing time to value if you partner with someone like Unit, whether it's a white label banking app. I think one little interesting anecdote to talk to is like your commercial charge card program, and you're partnered with OPFI and maybe some other folks. Talk about how it's now like a little bit easier to get a commercial charge card program up and running.
Yeah, so in the spirit of turning Unit into more plug and play, we stood up our banking and lending lines of business, and then we saw that in lending specifically, or in charge cards, we historically requested a lot from the client. So for any company like Baselane or Nav to stand up a charge card, they had to have underwriting policies, they had to have access to capital, they needed to have the bank's comfort with being done because it's a direct relationship. And we just found they had to do too much. And they all did pretty much the same things. So for many of them, it was cost prohibitive. The way we thought about it then was, if we have one recipe for underwriting and we allow one company that has the balance sheet and the sophistication and the underwriting models to do it all in one consistent way, it's a win for the bank because it's one recipe. It's a win for the customer because they don't have to do it. And it's a win for us because we can serve more customers. So OTFI is our partner in underwriting those businesses, extending lines of credit to them, and then those lines of credit are accessible through charge cards that those end users get.
Yep, totally. Put a user story behind that. It used to be if you want to stand up a commercial charge card program, I come to you, you say, great, you're good to go. We've got your partner bank. Oh, by the way, raise a debt facility, hire a chief credit officer, prepare to do like, debt covenant calculations to report to that partner, and then make sure it all ties in. And you're like, oh man, that's going to take me 3 months. It's going to cost me $200,000, $300,000 of like additional headcount a year, and I'm going to have more engineering overload. And now you're like, hey, we've got the commercial charge card, and we've actually got the programmatic balance sheet as well, which is great.
And in the spirit of making it easier, but not necessarily making it kind of the same forever, you can get started this way, right? If you serve, garage shops, and you might have more data to underwrite their business, but you don't yet have the full engineering resources and the full capital access that you need. You can get started.
You might not even know how interested the garages are in a charge card program. So like why?
Exactly.
Yeah.
Exactly. So that's an easy way to get started. And then over time, if you have more sophisticated ideas on how to underwrite them, you can either feed OTFI more specific data, or you can take over the underwriting altogether. And this is something that we also allow. So how do you less barriers basically for innovation that creates safety for the banks and more access for the clients is a question we keep thinking about.
So we've talked about a lot. We've covered a lot of ground. Let's just revisit the broad question we started with kind of at the beginning, was like, what does this all look like and mean for the next 10 years?
So I have a simple answer about financial services in 10 years, but it's our idea. I believe it's going to be less banks specific and more software heavy. So I envision a world in which we have thousands of software companies that offer financial services for small businesses and individuals, from Apple to Shopify. And again, because there are so many software companies in the world, and because they're getting so ambitious and high value, I think a lot of them have the permission to participate and do it right. So that's kind of how I think about the size of that wave, which is very different from the first wave. The second is, I think some of these companies like Nav are going to be horizontal in nature. They're going to have access to very different kinds of businesses, and many of them, and some of them are going to be very vertical. Baselane and Toast are ones that we think are highly specialized. Their definition of success is not 5 million end users. If they reach 500,000 each, they're going to be very, very successful. So I think that's going to be another kind of interesting delineation. And then the last thing is, we talked about the software, the trust, the distribution, the data of all these companies. I think this is going to compound to a meaningfully bigger advantage in the next 10 years than they had historically over the banks.
Yeah, and that's the most exciting thing, because you asked, what does the future look like? And it's like, I feel like you and I align on like generally what it looks like, but what do some of these specific companies look like? I don't know, because you could build a new type of company with a new value proposition doing different work than was ever possible before. And that's exciting, right? That's exciting to see what some of these things might actually look like, even if there is some like negativity and also just friction in the current moment. I've just got a couple fun, quick ones for you to answer. We'll see how this goes. So I'm going to give you two options. Choose one of them, ARR or EBITDA.
EBITDA.
EBITDA. Good answer. Feels like it's more in the water. Zach Parrott had a good answer, which combines the two, which is rule of 40, but he's clever and tricky. Two, New York City or Tel Aviv? And maybe also just tell what it's like to build a team between those two places.
Oh man, yeah. So I lived in Hong Kong between Tel Aviv, which is home, and New York City, which is my current home. I love all three cities. I think New York and Tel Aviv have their amazingness. I would say dual headquartered is our preference. I'm going to go with the smartest answer.
Yeah, I'm not going to make you split the proverbial baby here. ACH or RTP?
Same day ACH.
Same day ACH. Okay, good spin there. Which I don't think a lot of people realize is actually you can have same day ACH. And last one, B2B or B2C?
B2B.
B2B. I will say I see a lot more in the B2B space. Well, thanks so much. This has been super fun. Hopefully it's been very interesting for folks to kind of both get tactical about thinking about what Unit's doing, but then also looking to the next years of financial services. So thanks so much, Itai, for coming on.
Thanks for hosting me.